Okay, let's just cut right through the noise, shall we? In today's explainer, we're looking way past the sensational headlines, the endless hype, and, all those comment section skull emojis. We're going to see exactly how a trillion-dollar asset functions when it's put under real pressure. We are uncovering the actual structural mechanics of Bitcoin. So if you want to know what's really happening beneath the surface, you are definitely in the right place. Let's get into it. Right off the bat, let's dive into this pretty bold claim. According to our source analysis, the whole going to zero thing, it's really just a comfortable lie. It's a distraction that both the bulls and the bears actually prefer you keep asking about. Because out in the real world, you've got folks like Lindsay, a retail investor, sitting in a Sacramento parking lot before her shift. She's holding a position that's deeply underwater, and she's literally stopped telling her family about the numbers. On the flip side, you have a miner named Dale out in western Kentucky running 8 mining rigs out of a converted horse trailer, just doing stressful math on his power bill. Look, neither Lindsay nor Dale gets honest answers from the market, mostly because the emotional temperature of this conversation runs way, way ahead of the actual data. To truly understand their reality, we have to look at the hard numbers. Bitcoin has seen a 48% drawdown to the mid-60,000s from its October 2025 peak of $126,000. But I really want you to focus here, because our source material points out something fascinating. The drop itself actually isn't the most interesting part. It's exactly how that drop happened that completely changes the landscape for investors like Lindsay and Dale. When we contrast past drawdowns with what's happening today, a really distinct pattern emerges. Back in 2011, Bitcoin fell 93%. In 2021 and 2022, it took a 77% haircut. But those were violent, incredibly fast crashes. And here's the thing about a crash. It produces panic, and panic inevitably produces a market bottom. But this time, it's been this slow, agonizing 9-month staircase down. Step, pause, step, pause. As the data highlights, a staircase down doesn't create panic. It creates pure exhaustion. It produces this very specific 2 a.m. feeling where you actually stop being scared and just start being embarrassed. Section 1, Code versus the Plumbing. Let's take a look at what actually broke here. We hear this narrative all the time, right? Somebody attacks the network, the miners just walk away, and the whole thing collapses under its own weight. Well, the data absolutely debunks this. As of the middle of this year, the network has been running at or near record computing power. I mean, to put it into perspective, it would cost over $10 billion in hardware and over $1.5 million an hour in electricity alone just to attack the network. And here is the genuinely strange part of all this. Computing power actually kept climbing while the price fell. The miners were literally adding capacity into a falling market. The network itself is aggressively fine. So if the underlying code isn't breaking, what exactly is? This chart brilliantly illustrates what really broke. It was the plumbing. For years, we were promised that institutional money meant stability, right? The adults in the room would supposedly step in and stop the panic selling, but instead, institutional money replaced emotional humans with cold mechanical plumbing that operates strictly on schedules. Our 3 main structural holders, ETFs, miners, and corporate treasuries, all became forced sellers at the exact same time, not because they felt bad about the market, but based on strict, undeniable financial drivers. Let's break down exactly how massive this structural shift really is. Exchange-traded funds now explain roughly 45% of Bitcoin's weekly price movement, and they saw massive multi-billion-dollar outflows in June. Meanwhile, miners hit a single-quarter record of selling, offloading more than 32,000 coins. Why? Simply because mining revenue per unit fell into the $20 range, against a break-even cost to near $35 for older machines. Remember Dale the miner? Dale didn't sell because he suddenly lost faith in the grand vision. Dale sold because January was freezing cold and his power bill was due. And finally, you have MicroStrategy authorizing the sale of roughly 20,000 coins, literally just to cover cash reserves and preferred dividends. This wasn't some grand conspiracy. It was just a spreadsheet demanding action. Section 2, the Bitcoin obituary fallacy. Let's look at the bullish counterargument for a second. Now look, a bear case that refuses to concede anything isn't actual analysis. It's just a personality trait. And the bulls? They actually have some incredibly compelling data on their side. Here is a truly fascinating data point. There is an actively maintained website out there, complete with sources and timestamps, documenting exactly 475 obituaries for Bitcoin written by public figures and economists. If you had invested a mere $100 every single time someone officially announced Bitcoin was dead, you would have invested a total of $47,100 over the years. Today, that investment would be worth roughly $67 million. I mean, It's an absolutely incredible investment strategy based entirely on ignoring economists. But there is a massive trap hidden inside those 475 obituaries. It's known as the base rate fallacy. You see, relying solely on past survival isn't actually mathematical proof of future success. The source analysis points out a great truth. Being wrong for a long time looks exactly like being early from the outside, and you honestly cannot tell them apart in real time. Just because it has always bounced back before doesn't mean the cold, mechanical reality of today guarantees it'll happen again. Which brings our narrative right back to Lindsay sitting in that Sacramento parking lot. Back in June, the amount of Bitcoin held below its purchase price hit an all-time record of 10.83 million coins. Think about that. Over half of all circulating coins were underwater at the exact same moment. Lindsay is down 43%, which means she needs a 76% gain literally just to get back to even. The typical holding in America isn't some giant whale or a faceless institution. It's a few $1,000s held by ordinary people who couldn't really afford to lose it, but bought in anyway out of the sheer fear of watching everyone else get rich. Section 3. True long-term existential risks. What are the actual risks facing the network down the road? The ultimate risk here might not be the price going to zero at all. It might actually be the asset surviving indefinitely without ever returning your capital. There is a very real structural argument underneath that survival risk. Imagine a miner as a club bouncer guarding this trillion-dollar network. He gets a guaranteed salary from the network, that's the block reward, and he gets tiny little tips from transaction fees. Right now, the tips are just a fraction of a percent. The salary is everything. But every 4 years, the halving mathematically slashes his salary in half. Run that timeline out to 2036, and his salary is just 1/8 of what it is today. For the network to survive, either the value of the coin has to skyrocket 8-fold, or transaction fees have to grow by a factor of over 100, or the guy guarding $1 trillion just has to agree to work for pennies. It's a massive math problem waiting for us a decade down the line. And then there is one more existential risk that got dramatically more real this year. It's outlined in a code proposal called BIP 360, and it is genuinely fascinating and honestly slightly alarming. We're talking about the looming threat of quantum computing. Over a third, 34% of the entire Bitcoin supply currently sits in vulnerable addresses. These are addresses that have revealed a public key on the blockchain, making them theoretically crackable by future quantum computers. The sheer scale of what fixing this would actually entail is staggering. Google researchers recently cut the estimated resources needed to execute a quantum attack by 20-fold. Now, while experts like Adam Back estimate this threat is still 20 to 40 years away, others are saying actually it could happen in 5 to 7 years. A companion proposal to BIP 360 laid out a pretty dramatic plan. To protect the network, developers might literally have to migrate or permanently freeze between 6 and 12.7 million coins. And yes, this includes an estimated 1.7 million coins widely believed to belong to the creator, Satoshi Nakamoto. Just think about the supreme irony here for a second. To protect the world's premier unconfiscatable money from quantum computers, the network itself might have to permanently confiscate a third of its total supply. Section 4. 3 questions for investors. Let's bring this all together. Endlessly arguing about this extreme going to zero scenario is just a trap. The bulls love it because it's incredibly easy to win, and the bears love it because it makes them sound brave and contrarian. But falling for this trap prevents investors from evaluating what actually dictates the fate of their hard-earned money. Before we get to the questions you really need to ask yourself to avoid that trap, I want to remind you of a guy named Hollis. Back in 2014, Hollis put $500 into Bitcoin because of some peer pressure at lunch, and then he promptly forgot his password. Hollis perfectly represents the estimated 4 million permanently lost coins in the network. He has been contributing to the bull case by upholding the scarcity argument completely by accident for 12 whole years, receiving absolutely nothing in return. And sadly, this is a suspiciously accurate description of how a lot of people experience this asset. So, to avoid being like Hollis or waiting nervously in a parking lot like Lindsay, the source material suggests walking through 3 very specific mechanical steps. Step 1. Who is the actual buyer after you, and what do they have to believe to buy your coins at a higher price? Step 2. What must be specifically and numerically true over your holding period? Don't just hope, you actually have to do the math on your break-even point. And step 3. What does not going to zero actually get you if it takes 15 years just to break even? Remember, simply sitting out and not having a position at all is a completely valid mathematical choice. It has its own return and risk profile, and the best part? It doesn't require you to successfully predict the future of quantum computing. I want to leave you with this final provocative thought today. If you can answer these 3 questions out loud without flinching to somebody who actively disagrees with you, well then, you truly grasp the mechanics of this asset. You are no longer reacting to emotional noise or comfortable illusions, you're finally dealing with reality. So ask yourself, what does an asset surviving but without actually returning your capital mean for your financial future? Thanks for joining me for this explainer. Keep asking the tough questions, and I'll see you next time.